SPAXX or SPAXX is a great option for any investors looking for a high yield in their portfolio for passive income with very minimal risk in their investment. Welcome back to the Financial Freedom Show. In today's episode, we're going to be exploring SPAXX or SPAXX, what it is, how it works, and why it could be a good option for your portfolio for 2025. Before we get into today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest in videos from our channel. And if you want your name to be at the end of every single video that we publish, be sure to check out the description and below for the join button so that you can join our membership program on our channel. But without further ado, let's get into today's video. So whether you're new to investing or looking for a safe place to park your cash, this episode is for you. We're going to be exploring SPAXX or SPAXX, what it is, how it operates, and why it's become a go-to option for so many investors. So what is SPAXX? SPAXX stands for the Fidelity Government Money Market Fund. It's a type of mutual fund that is specifically designed to provide safety, liquidity, and income for investors. Unlike stocks or bonds, SPAXX focuses on ultra-low risk assets, making it an ideal option for parking your cash between investments, earning a stable yield on idle money, or managing liquidity in your portfolio. SPAXX is often used as a core position in the Fidelity brokerage accounts, serving as a default option for uninvested cash. But what makes it so special? How does it work? SPAXX operates by pooling money from investors using it to buy high-quality short-term debt instruments. These can include U.S. Treasury bills, which are government-backed securities with a maturity of 1 year or less, repurchase agreements or repos. These are short-term loans that are backed by government securities, or other government obligations. These are high-quality, low-debt risk assets issued by federal agencies. These instruments are considered some of the safest investments available, ensuring that SPAXX's principal remains stable and fixed at $1 per share, while still generating income through interest payments. What are the fees and yield of SPAXX? One of the great things about SPAXX is its cost effectiveness. Here's a breakdown of the fees. So the expense ratio for SPAXX is 0.42%. This fee is automatically deducted from the fund's returns, meaning that you don't pay it out of pocket. Compared to other investment options, this is relatively low for the level of safety and convenience it provides, as well as liquidity. The yield, so for SPAXX's yield, it fluctuates with prevailing interest rates. As of now, the fund's yield has grown significantly due to the Federal Reserve's interest rate cuts, of all things, offering a competitive payout that can rival or exceed high-yield savings accounts. So as interest rates go up, the payout of SPAXX goes up. Who created SPAXX? SPAXX was created and is still managed by Fidelity Investments, one of the largest and most reputable financial service companies in the world. Fidelity was founded in 1946 and has a long history of innovation and customer-focused solutions, making it a trusted name for millions of investors. The management company of SPAXX is handled by a team of experienced professionals who ensure that the fund adheres to its objectives of safety, liquidity, and income. Their expertise allows SPAXX to remain a reliable option in varying economic conditions. Here are some of the key features of SPAXX and why you would want to include it in your portfolio for 2025. So some of the standout characteristics of SPAXX is that it makes an appealing choice for many investors due to its safety. SPAXX's portfolio is backed by the U.S. government or high-quality institutions, making it one of the safest places to store your money outside of an FDIC-insured bank account. It's basically a high-yield bank account that you're investing in government securities. Another important feature is the liquidity. You can access your money at any time without any penalties, making it a flexible option for short-term needs. So unlike a CD or some of the high yield savings accounts, there's zero penalties for withdrawing your money from SPACs at any point, and you'll earn the interest in between the period from when you've first put your money in to when you pulled it out. Another good thing about SPACs is the yield. While historically lower than riskier investments, SPACs' yield has grown significantly due to rising interest rates, making it competitive with high-yield savings accounts. It's almost 5% interest right now, and you can earn even more if the interest rates continue to go up. And lastly, there's just the convenience of it. As a core position in Fidelity accounts, SPACs automatically invests unallocated cash, ensuring that your money is always working for you. So as you put money into your Fidelity portfolio, your cash is automatically invested into SPACs as a core position. So basically every dollar that you put into your Fidelity portfolio that's not invested, it just gets automatically dumped into SPACs so that it can earn interest over time. Who should consider buying into SPACs? SPACs isn't just for conservative investors. Here's a few scenarios where it actually makes sense for any investors to use SPACs. So for new investors, if you're just starting out or want to preserve your capital, maybe you're saving up for a down payment on a house, SPACs is a great option for beginners. For seasoned investors, it's a good option to use SPACs as a holding area for your uninvested cash while you wait for the right market opportunities. Or you could put in your emergency fund and use that in SPACs just to earn interest on your emergency fund. There's a lot of different options for seasoned investors to use SPACs. Retirees, its low risk and steady income make it a reliable choice for those seeking stability but also income. And lastly, like I just said, it's good for emergency funds. SPACs' liquidity and safety make it an excellent option for your emergency cash reserves. Because it's available at any point, you can just pull it out of SPACs and use it for whatever you need it for without any fees. So SPACs is really good for any emergency funds. I personally have my emergency fund in there. So why is SPACs a good idea for you to purchase in 2025? One of the main reasons SPACs is gaining attention now is its rising yield. With the Federal Reserve lowering their interest rates but starting to slow down their interest rate decreases, SPACs payouts have grown. They're offering very competitive returns without the risk of market fluctuations. And this trend makes it an attractive option for investors who want to avoid the volatility of stocks while still earning a consistent return on idle cash, and also benefit from rising interest rates without locking into long-term investments. One of the good things about SPACs is it's actually earning quite a high yield compared to any other funds. Basically, you're earning the same yield or more as STHD or any dividend funds, while no risk on your underlying asset. So basically you're getting the dividend without the underlying risk of the asset itself. And over the past year, the Federal Reserve has been lowering interest rates because inflation has kind of gone down. But recently they've signaled that they're going to slow their interest rate decreases. So this is going to make borrowing more expensive. And it's also created a golden opportunity for savers and investors to begin earning more money in SPACs in 2025. So SPACs benefits directly from higher interest rates because the securities it invests in, like treasury bills, they offer higher yields when rates go up. For example, in 2020, when rates were near zero, SPACs' yields were minimal. If you fast forward to today, SPACs is offering significantly higher payouts, sometimes rivaling traditional high-yield savings accounts and even some dividend funds. This monthly payout can really add up, especially when reinvested, and it creates a compounding effect that can accelerate your wealth building over time. So why could SPACs make you rich in 2025? Here are the 3 reasons that SPACs could make you rich in 2025 and be a cornerstone of your success next year. The first is a consistent income stream. With interest rates expected to remain elevated next year, SPACs will likely continue delivering strong yields. Monthly payouts mean steady cash flow that you can reinvest or use to cover your future expenses. Number 2 is low risk growth. SPACs' focus on government securities ensures that your principal remains safe while you enjoy the benefits of rising yields. If the market crashes, your SPAXX investment pretty much stays the same. Number 3 is flexibility. Whether you're using SPAXX to manage your cash in your brokerage account or as a safe haven during market volatility, it's a versatile tool for any portfolio. So for final thoughts, SPAXX isn't a get-rich-quick scheme, but it's a low-risk, smart way to grow your wealth over time, especially in a rising interest rate environment. By taking advantage of its increasing payouts and reinvesting them over time, you'll be well on your way to financial success in 2025 and beyond. If you found this video helpful, please be sure to like and subscribe to the channel in order to stay up to date with the latest in the Financial Freedom Show's episodes. And let us know in the comments, are you investing in SPAXX or another money market fund? We'd love to hear your strategy down below. Hope you enjoyed today's video, and I will see you in the next one. Thanks for watching.